All right, so welcome to this evening's webinar. What we're going to do is we'll start off by just taking a real basic look at the major indices, the main stock market indexes, just to kind of give you a rundown of where we're at, and then we'll take a look at your individual stocks. And like I said, we'll keep that part of the session brief because tonight's session is going to focus on looking at your individual stocks and ETFs. So what you're looking at here is a daily chart of the SPY, the S&P 500. As you know, we've been in a steady uptrend for quite some time now, ever since forming a low at the end of December. Today's action, we did have a bit of a bearish candlestick pattern form, kind of a shooting star, I guess you'd call it, or an inverse hammer. Nothing to be concerned of at this point because we don't have any distribution days on the board, but not a real positive day. I mean, the main problem we had today, of course, was this, and that is Apple. When you have Apple down 60 points, Apple's obviously a very large percentage of the NASDAQ, so that kind of weighed on everything. So if you take Apple out of the equation, and you can see it sold off in heavy volume, if you take Apple out of the equation, then the market actually held up pretty well. I mean, looking at the NASDAQ 100 index, QQQ, we did actually close lower on the day, but you'll see right here, QQQ closed right at support of the 20-day exponential moving average, which is this beige line right here. So tried to break out yesterday, kind of a false breakout. Now we're back to support, but false breakouts are not a bad thing, as Rick and I will probably address later in this webinar. False breakouts actually provide a low-risk buying opportunity because they shake out the what's known as the weak hands. To give you a 1-minute overview on our trading strategy, I mean, I won't. I could spend all night talking about that, but I won't. Basically, we're short to intermediate term technical traders that look at intermediate term trends. We do 3 main types of plays, technical setups with our trades for our stock and our ETF trades. One of them is breakouts. We trade breakouts of consolidation, and we'll be looking at a lot of examples of those. Stocks and ETFs that have been consolidating for a period of 4 to 8 weeks on average, and then breakout above that. Those of you who read our daily ETF commentary in the Wagner Daily newsletter, if you're a subscriber, or occasionally you'll see it on our blog, we occasionally talk about the requirements such as higher lows and tightening of range and so forth, breakouts of consolidation. The other type of trade setup that we take is actually a pullback trade. And that's where we take something, looking at a broad market index, for example, something like the Dow, the diamonds. This is in a steady uptrend, so obviously we wouldn't want to buy up here because it would be a negative reward to risk ratio. But if this was to pull back, for example, down to the 20-period exponential moving average down here, and then form a bullish reversal candle, then that would present us with what is known as a pullback trade. That's where we trade something that's in an uptrend, pulls back to support. Now generally, breakout trades is what we prefer in a healthy market because they have the most potential for upside gains. But the benefit of a pullback trade is you have a positive reward to risk ratio because you can have a very tight stop loss below the low of the reversal candle. And then you have the ability to, when the stock continues its uptrend, to make a lot more on the upside than you're risking if the trade stops out. And the third type of trade we take is a trend reversal. That's where something's been in a downtrend for an extended period of time and then reverses its downtrend. Now, this is not to be confused with bottom fishing. We never buy anything that's at the lows. We actually wait for confirmation that a base is formed. There's a lot of proprietary indicators we use, but one example, for example, would be KOL, which is struggling a little bit here, but notice it's been in a base now for many months and it's trying to reverse its downtrend. So that's just a simple example of a trend reversal kind of play. Now, the question always comes up, do we sell short? Yes, we do sell short, but the most important thing for you to understand is that we are trend traders. That means we trade in the dominant direction of the broad market trend. If the broad market's in a confirmed uptrend, we only buy and on the long side of the market. If the broad market's in a confirmed downtrend, then we sell short. And if it's indecisive or choppy, then we're either in cash or maybe a mix of both. We also tend to trade both ETFs and stocks. Our Wagner Daily newsletter trades a combination of ETFs and stocks, and the benefit of that, what's really great about that, is we get the best of both worlds. If it's a strongly uptrending market, stocks will tend to outperform ETFs, will make larger gains on the leading stocks. But if we're in a choppy market where stocks are not really going anywhere, we have a lot more opportunities, a lot more options with ETFs, because ETFs, we can trade commodities, currencies, international ETFs, and ETFs that have a low correlation to the direction of the broad market. So we actually have a proprietary market timing model. Maybe some of you have read about in our blog, or if you're a subscriber, you already know about it. And the percentage of stocks versus ETFs we trade is really just dependent on market conditions. A big key of our strategy is we never try to predict what the market's going to do. We're not in the business of predicting. Rather, we simply look at what the market is doing, and then we react. And we use a very simple trading strategy. So again, I don't want to be long-winded. I could talk all night about our trading strategy. Most important thing for you to understand is that it is proven. If you go to our website, just real quick, I'll show you our website here. This is morpheustrading.com is our website. If you were to click on this performance tab right here, where it says performance, you actually see our performance for the past almost 11 years now. We've been tracking the performance of every single stock and ETF pick we make in our newsletter. One of the few services out there that actually reports both the winners and the losers of every single trade. And it's a replicable model portfolio, so you can actually take every trade as well. If you look at that, you'll see that the system that we do is proven to work. Do we have losing months? Do we have losing days? Of course we do. Our system is designed, however, though, to outperform the broad market by a wide margin over the long term if you follow the system. Okay, so enough about that. So what we're going to do is go ahead and open up to questions. And again, as I mentioned, the format here, just type in any stocks you'd like to look at. Well, let's start off by looking at chart patterns. And the idea here is that even if it's not a stock that you personally are interested in, the idea is that you'll learn a lot about the way we analyze stocks just by looking at or listening to the commentary that we give on each individual stock play. And then near the end, if you have any questions that are more general questions, try to save those for the end. Maybe you could jot your questions down and save them for the end. But let's begin with just looking at actual chart patterns. Just type the ticker symbol in the questions box. And then at this time, I'm going to go ahead and turn it over to Rick, and Rick's going to do some of the analysis for you. So.
Okay, first question, NSR. All right, the one thing in future questions, if you guys can let us know if you're, I guess these are all longs. I guess everyone's going to be looking for long, I'm assuming, so I'll just assume that everything's long. And I'll tell you, I guess I'll describe if you're long or if you're looking to get long. I'll put that all in the description, or my analysis, I'm sorry. So anyways, you have your breakout, not much of it. Here's the base. You have your breakout, and it's just kind of chopping around. That means it's not ready to go, so it's still holding in a tight range, though, making higher lows along the lows of the base. If it can get above the 3-day high, that's great. If it can get back above these two the highs of these two bars, that's even better. So so far it's a hold. If it gets below the 3-day low here, it could roll back over, and that could put the stock into some trouble. But basically, if it can break above the 3-day high, it's a buy if you want, and if it gets back above these, if it can clear these two highs, that's even better. V. Pull back to the 20-day EMA. No follow through though on the move above because it was a gap, so filled the gap. If you can get back above the 2-day high and hold, you could see a resumption of the uptrend. Your stop would be below this reversal bar. You don't want to see that reversal bar fail. If that reversal bar fails, that means that V is going to base out for a few more weeks rather than head higher. That also could be true if V does follow through to the upside and breaks above this line but fails to follow through right there and comes back below this trend line. That means it's a false breakout. That might lead to several weeks of basing action because, as you can see, it's been in trend mode for several months now. So here's the breakout, probably base breakout anywhere in the 123 to 130 range, so quite a ride already, so it might be a little bit late in that rally. TRMB, Looking pretty good. It's just extended right here. I mean, if you've owned it for a while, you might look to lock in some gains. If you're just looking to buy here, not much of a base. You know, what we look for is we have a base, which is in this level here. You have a breakout. Once a stock is extended more than 20 or 30%, each subsequent base becomes a little bit, you know, the odds increase that it could fail. So TRMB is about 20% extended from its last true base. So with today's false breakout, it might mean that it needs a few more days or another, I'd say probably a few more weeks, because it is pretty far extended from its base. So if you own it, it's probably time to lock in some gains. If you want to buy it, I'd wait for a few weeks more basing action. And BLK, BlackRock, another one. I mean, base breakout, pullback one, second pullback, and now it's very extended here. Nothing to do with this one really. If you own it, great. It's up 23% from the entry point. I don't know if it's from your entry point. It's up 23 from the base breakout, and it's up 15 from the pullback entry. So time to look to lock in gains if you're a swing trader. Definitely not time to buy if you do not own the stock. You simply have to wait for a new base to form here. Just way too far extended. Okay, next one. Just a general question here. If the market if the market intermediate term trend is, if the market intermediate term is in an uptrend, do you trade on the short side of the market? Absolutely not. We don't mess around with the short side once the market's going higher. And if you look at statistics, market statistics that is, I have some scans that I run. You'll find stocks that have rallied 20% over the past 4 weeks. You'll have maybe 50 to 100. Stocks that have sold off 20% over the past 4 weeks, you'll have like 3 to 4, 5 out of 1,000. So those are pretty tough odds. So
yeah, Rick, can I add something when you're done there?
Sure, go ahead. I mean,
that's a very good question. It's a common question we get. You know, do we trade counter trend moves if we're in an uptrend, and you know, do we try to catch pullbacks, for example? You know, we're not about, one thing that's important to understand with our system is that we're not trying to catch every nook and cranny. You know, some traders think that in order to be a successful trader, they have to be in the market all the time. And, you know, so if the market's in pullback mode, they got to be short for 3 days and then go long for 3 weeks and then short for 3 days. And I guess a very small percentage of traders can do that, but the majority, even if we tried to do it, wouldn't be able to follow us. And it's just, the odds are not in your favor. So we just simply, we use a very simple system that enables the odds to be in our favor by following the momentum. Rather than going short on the pullbacks, it's simple to trail our stops tighter, lock in the gains, and just wait for the pullbacks and then get long again. This is what our market timing model is designed to do. And I don't know, Rick, it might be worthwhile to spend a minute or two at some point just discussing the basics of our market timing model for those who are new to our system. But I'm done. Go ahead.
All right. So next question is FTE. As you can see, I zoomed out. This is a monster downtrend. This is what you don't want to touch when the market's going higher. You don't want to be anywhere near this. The only what we absolutely look for in anything we trade is for higher highs and higher lows, and for the price action to at least be above the 50-day moving average, which was starting to happen back in the late summer. But as you can see here, it failed to hold the higher swing lows, and then obviously it failed to hold the bottom of the base. So this trade is not something that I would ever do basically. But if you are long FTE right now, you pretty much have to wait for, let me go to a weekly chart. You have to hope for this downtrend line break to hold and for the price action to return back above 1260. to get any kind of momentum going. So if you own it, I mean, it's going the wrong way, and you might want to have, that's why I don't want to give anyone any buy and hold advice. I don't know what you're up to. I don't know what your plans are, but for short-term swing trading or intermediate term, which is what we do, this is just has too much negative momentum for to warrant any kind of trade. So unless it can get back,
And also, sorry to interrupt, Rick. Just wanted to say also, it's important for those of you who are new to Morpheus to understand that we're not value players. We're not long term. Just as Rick said, it's technical. So I mean, very important point. We're not giving advice. We're not licensed brokers or anything like that. But we're just telling you based on our strategy what we see. Sorry, Rick. Go ahead.
sure, no problem. So basically, unless FT can get above 1270 and reverse its momentum, really, it just looks like it's going to continue to go lower. So next up is MT.
Oh my.
Another downtrend, but it's trying to form some sort of base here. I see what it's trying to do, but again, this is in a downtrend, so a lot of momentum going against this setup. And you have this downtrend line also. So in the short term, if it can get above this 3-day high, it could pop to this 20 to 22 level, and that you might see that as that's a decent move, but that's not what we look for. But if that's what you want to do off the lows, you are fighting a lot of downward momentum, but it could see a pop to the 20 to 22 level in the short term.
Rick, if I may, I want to talk just for a moment about what actually creates resistance and support levels. When Rick just mentioned that you're fighting a lot of downward momentum with this stock, what that means, everybody, is that there's a lot of overhead supply. A lot of people think that technical analysis, if they're new to trading, they think it's like hocus pocus or some kind of magic, but really all technical analysis is just simply a way of plotting the human emotions of fear and greed and hope and regret. And so what happens is when these stocks that have been in a downtrend for a long time, when they try to move higher, everybody who bought at a higher price, such as 6 months ago or a year ago, they're selling the stock just to try to break even. That's the human psyche. Let me just get out of this and break even. So that's what causes resistance. It's not the trend lines or the moving averages that cause resistance. They don't cause anything. They just indicate where the resistance is likely to be based on human psyche of selling into resistance because somebody bought at a higher price. That's known as overhead supply. So in our newsletter, the Wagner Daily, whenever we talk about overhead supply, that's what we're referring to. Conversely, you have overhead supply, and then you have demand when stocks are pulling back to a support level. People buy when it pulls back to a support level. So just wanted to throw that little tidbit in there. Go ahead, Rick.
Thank you, Darren. Okay, and I just want to quickly point out that this shorter term trend line, kind of like this beige color, is the 20-day moving average. It's an EM exponential moving average. This teal, blue, whatever, lighter blue is 50 MA, and the orange is the 200 MA. Those are simple. So last chart is EONG. EONGY. Another downtrend. So it's got a lot to fight through. It's in danger of breaking down to new lows.
Sorry, but it looks like a good short if we were at a downtrend.
Right. So this is a tough long, tough place to be long, really. It's got a lot of downward momentum. It looks like it's headed lower. On the daily chart, yeah, I mean it really difficult because it's broken its uptrend line here. It looks like it's rolling back over. Hit resistance of the 50, that's sloping lower 20-day MA is after going sideways, being in a slope lower. So nothing good going on in the ONGY. It just looks like it's headed lower. All right, next question is TLSYY. TLSYY. Okay, base breakout, first pullback, still it's basing again. I mean, if whether or not the question is here is let this one continue to run or to exit. Well, it depends on how you want to play it. If you want to play it real quick, I assume that you probably would have sold already. So sorry about that. Let me pull this chart back in. So if you're looking to continue to hold, the way I would do it is, if this breakout works here, put your stop beneath the lows of the base and the 20-day moving average, and just continue to trail your stop. If price action goes up again and it forms another sideways range like this, continue to trail your stop with the position if you want to play it slow. If you think you've made enough already, you want to get out, well, if it fails this recent breakout here, it goes below this 3-day low, you might want to look to exit because it's probably going to pull back or consolidate for a little bit more. Next question is TNA. Small cap bull. Right now it's just a do nothing. Just wait and see. If you own it, depending on where you own it from, you might want to place a stop beneath yesterday's or today's reversal bar, depending on how badly you want to lock in gains. If you're looking to buy, there's really nothing you can do right here at this level. It's already exploded higher on the gap up. If you wanted in, the gap up was the time to buy, and that's pretty high risk too. So I know it was tough to buy some stocks.
This would be an example of a pullback trade like we were talking about earlier,
right.
If you missed the breakout.
And after a significant run up, you want to be careful about buying the first pullback, because then it might be a little bit too volatile. But if there happens to be a 2 or 3 day, 4-day pullback that's a little bit more, flat or orderly, rather than just getting blown up or having 4 or 5% down days, that might be a little bit more reliable. But after such a big move up, you might want to just let it base for a while and not have to go after the first pullback you see. Most of our pullback buying, as most of our subscribers will know, is done near the base or the first pullback after a breakout. Once it's 15-20% beyond our pivot point, which is where the stock breaks out, we kind of just let it go. We no longer attempt to trade it. Wait for a new base to form. XIV is the inverted VIX. This is something that we really don't focus on, is the VIX to trade, but pretty strong breakout. It's again when you're swing trading, the idea is to buy when there's a lull in volatility, and you catch the volatility expansion. And here we're in a volatility expansion now with XIV. There's nothing to do if you own it. It's probably if you want to lock in gains, I think selling tomorrow on the open after this type of a reversal day is okay. But if you want to hold on to it, then you're probably going to have to trail a pretty wide stop. Here's the uptrend line. You're probably going to have to go below the 20-day moving average. I really, if you want to be out short term, probably best to get out tomorrow morning or trail a stop, pretty tight stop near the highs here, or at least below yesterday's low. Probably don't want to give it all the way down to this 21 level, but if you really want to lock in gains, if you don't own it, again, it's nothing to own right now. It's just had a volatility expansion.
Yeah, this is actually, let me also point out, Rick, that this is also an inverse ETF. So this moves in the opposite direction of the VIX, and the VIX generally goes higher when the market becomes more volatile. So if today's pullback or today's bearish reversal happens to have any near-term follow-through to the downside, then this is likely to go lower as well. And the worst thing about this is that these VIX ETFs and inverse VIX ETFs, they really have a bad correlation to the actual underlying index. There's a lot of contango issues that you have to deal with, which is a whole other issue. But yeah, I would concur with Rick that this is something that if you're already in it, keep a tight stop, and otherwise I wouldn't be looking to get in this unless it actually pulled back to a nice support level there around 20. Go ahead, Rick.
Thank you. All right, LCC, next question. Great chart over the past few weeks. This is exactly what we look for those of you who want to know what we like to trade. This is a tight pattern with a nice breakout right here, and then a false breakout and pull back, and then another breakout, a little re-breakout, and about a 20% move up, and then it's pulled back. So this would be the pullback entry right at this level over the high of 115. As you can see now, I mentioned earlier, when you have a pullback and then you have a move out and there's a false breakout here, it suggests that there's more, the stock needs more time to consolidate. Now, I wouldn't have expected LCC to a false breakout again, seeing as this is just the first pullback. You would expect more upside, but you never know with stocks. So the false breakout suggests that there's more of a consolidation, and it followed through to the downside today. So maybe 3 to 4 weeks sideways here, forming another base on top of the 20-day moving average. As long as the stock holds above the 20-day average, I would, I wouldn't have any problem with that. That's productive price action. As long as it's setting higher lows within the base, holding above the 20, that's fine. If it breaks 20 and starts to sell off down to the 50, I'm not going to love that. I'm probably just going to pass on it, take it off my watch list, and replace that with something else. TBT. Okay, this is basically going along the rates. Here are the bonds which have broken down below their base lows here. Well, they've touched the basically double bottom off the base lows. They've lost all sorts of momentum though, a bunch of lower highs in place. As you see, the 50, the little death cross, the 50 is now below the 200-day MA. 50 sloping lower. The one issue I have with TBT is that, it looks pretty good in that if it can get above this downtrend line, it's probably going to push higher. And if you're going to have a stop in TBT, I think it's pretty tough to run a stop beneath a swing low because it's so choppy. You might have to go beneath a former swing low to keep in the trade. So you might have to put your stop down here. But the one question I have is when people want to get into the rates to go long, I ask you, why go into rates when the market's going higher? You can get into a stock, and I think that's a better use of your money. You can get more bang for your buck out of going along a stock with some beta, and if it's a leading stock, you'll probably be able to capture some alpha, which is outperforming the market. So if you're running to rates, you're not going to probably get a significant move, and the reality is it has a low ATR, which is the average true range, which measures the stock's volatility, and it carries a higher price. So what that means is it ties up more of your money and doesn't move as fast. So, and when you're swing trading, the goal of all swing traders typically is to be in and out of positions as quick as you can, and to rotate the portfolio as you can make more money that way. So TBT looks pretty good. As I mentioned, above today's high tomorrow is a trigger. If you want, you can put a stop around $63, something I might do for half maybe, and the other half below the this prior swing low, and hoping that it holds the 50 MA. Next question is Kihu Technology. This is a pretty strong stock. It had a rough day today, false breakout, sort of like what LCC did. Here's the base breakout. Here's a second breakout. It's sort of a re-breakout when it fails to go the first time. Would have expected it to run higher. It didn't. So we're looking now, just like LCC, for it to hold above the 20 and form a new base. Yeah, the volume's high, and it's just not. It's not a good sign in the short term. That means it's probably going to consolidate. Yeah. I wouldn't be so concerned at. It's just a little bit over half, about 300,000. If it was 5 times the selling volume and it closed at the dead lows of the day and the stock was really extended, I'd say that that's a top. But that volume's not great, but there's some selling there, and it might just take a few weeks to work off, a week or two to work off that volume. But
exactly, it's probably going to be in pullback mode. It'd be hard to snap back to a new high unless volume actually exceeded today's level in the next day or two. So that's the point I wanted to make. Not that the uptrend's over, simply that this is a good sign that the stock may be in for some consolidation.
Yeah, so probably a week or two consolidation. So it's doing nothing right now. So if you're long, it depends from where you're long at. But if you're long from lower prices, you might just want to see if it can hold the 20-day moving average, and maybe give it 3 to 4% below the 20 as a stop. If you've been long for quite some time, maybe today's the day where you take your profit. You really don't have to worry about catching a top. If you wanted to, if you don't want to sell here and you wanted to sell at 33.75, well, you missed your chance, and I think it's better to take profits off if you have them, and move on to another stock and see if Kihu can hold up. Next question is MUX. Downtrend. It's a breakdown. This is more of like a short, really. But failed to hold the uptrend. Wedging, I guess, this trend line at the lows of the base here. This wedge, and 50 sloping lower, the 200 sloping lower. This is just in a lot of trouble. So
let me add something here, Rick, if I may. I'm guessing that when David's asking about MUX, I mean, David, if you're short, that's great. But if you're long, this is a situation where a lot of newer traders, and of course I don't know how long you've been trading, but this is a situation where a lot of newer traders, if they're long, they get themselves really into trouble. They have a big gap down day where it breaks below support, and they say, well, let me just wait the next day and see what happens. And next day it gaps lower because of the momentum, breaks the prior swing low from November, and next thing you know, the stock, when you could have been out with a small loss, now you're looking at a big loss, and it turns into a vicious downward circle. So if this is something you're long, and I'm assuming you're not short because it's a $3 stock, this is what I personally would do. Is I would have a very tight stop right below today's low. I think it's something that needs to be addressed, because don't fall into hope mode. I mean, I wrote an article on Hub Pages. You can just type in Hub Pages, Darren Wagner, and you'll see that the dangers of falling into hope mode. And I think the psychology is very important to understand. Go ahead, Rick.
Good point, Darren. And to add to that, I want to make sure that everyone, if you're swing trading, you have to have your stops in place. And you have to be realistic about what you're trying to accomplish. So if I don't know where you bought MUX, but you have to have a stop in place somewhere, and stick to that stop no matter what happens. Next up is AG. Breaking down as well here. This is, when you're looking at, in hindsight, we're analyzing everything. But you have a shakeout, and that's great because it held and it gapped back up. When a stock shakes out, there's a shakeout below a prior swing low. Everyone gets scared out of the stock, and they get stopped out, and it jumps back into the base. That's solid price action if it holds, and it did. Once it breaks down again, we're no longer in a shakeout. Something is wrong with the stock. So, and it bounces to the 20-day EMA. Go ahead, Darren.
I'm sorry, Rick. It's a little difficult where there's a couple second delay here. I don't mean to interrupt you. I just wanted to say though that here again, for those of you who are new to swing trading or technical analysis, the reason Rick said, there's something wrong with the stock. The reason doesn't matter. Don't get hung up on, well, is there news or is there something wrong, whatever. The reason doesn't matter. When you see that big red bar and it breaks the prior low or it comes down there, the reason is completely irrelevant. This is why you have to have mechanical stops, and you got to be like a robot, man. You got to just not even think about it. So I'm just throwing in some psychological tidbits here, which is what I like to talk about. So go ahead, Rick.
That's good stuff, and Darren's absolutely right on that. So, anyways, AG. So, if if you've bought up here, there's something wrong, and you're in hope mode if you're still holding on. It's not going the right way. It's breaking down below all support, and it's got a pretty steep downtrend line that it might not be able to get it back above for some time. We don't know. Support probably is this level around here, but when support is never just one level, it could dip below here and come back up to, dip below to 1450 and then come right back up. So think of support in terms of something like these two lines here. You never know. It's not going to be perfect, so it could come all the way back right down. And the reason why I say that is because usually when a stock goes right up with no basing action, it can come right back down just as fast. So nothing really to do in AEG except wait for a better pattern to form. Right now it's not a bullish pattern at all. EXK, breaking down here, not a good sign. Breaking a significant support level, and
for this, you might want to actually look at the chart of Dust, Rick. This is a silver company, but it trades similar to gold. Dust had a big breakout today. In fact, it might be on the Wagner Daily watch list tomorrow, possibly as a breakout play. It's an inverse ETF for the miners, and this has a very similar pattern inversely. You have trend reversal. If you draw a downtrend line from the high there of April 2012, you can see it broke that downtrend line on bigger volume today and broke above the range of the past several months. This is an inverse ETF that trades in the opposite direction of the underlying index. By the way, for those of you who are new to trading, inverse ETFs move the opposite direction. So when this is the gold miners bear, so when the gold mining stocks move lower, the ETF moves higher, which is a great way, by the way, to, and we're not in a bear market, but this particular sector may be entering a bear market, and it's a good way to get bearish exposure for those of you who have accounts that you can't sell short in, like an IRA account.
All right, so that was EXK. So next question is AKAM. Akamai looking pretty good here. Pull back after a base breakout. So basically, if it can get going above this 3-day high here, that's good. It's in good shape.
Notice the relative strength there too, guys. Today the market was down and this stock closed higher. That's a really good sign. I know it's only one day, but that's a good sign that the stock's really showing healthy price action. I mean, if a stock can move higher when the broad market's down significantly, this is a really good sign.
Right, so some decent relative strength there, and so it's a buy over the $40 level with the stop around 38, 80 if you want to be tight, or 38, 40 if you want to give it below the 50. So it's looking pretty good. On all these stocks, you guys have to check for earnings because we're in earnings season, and you don't want to hold. You have to be aware of what you're holding through earnings because the price action can be pretty volatile after the reports, and you don't want to get caught in something that where you take a big loss and it was unnecessary. ROSG.
One thing I'm noticing here, a lot of these stocks we're looking at that you guys want to look at are below $5 a share. $5, $4, $3. They don't technically qualify as penny stocks, but they're very low price shares. Now, when I was a new trader many years ago, I used to try to trade these kind of stocks too, because I had a small trading account, and I thought, well, better to trade the low price shares because I can buy more shares of it and I can make more money. That's a major fallacy. In fact, I'm going to be writing an article on our blog very soon talking about that. Because what you fail to understand is that it's not really the dollar, it's not really the dollar amount that matters, it's the percentage amount that matters. So, for example, if you buy, even if you can only buy one share of Apple, bad example because Apple's trending lower, okay, but let's say 6 months ago when Apple was jumping $20 a day, you're only buying one share, but on a percentage basis, you're gaining 1% a day or something like that. Don't limit your accounts, even if you have a small trading account. Even if you're only trading with a small account, several $1,000s, $10,000, whatever. Don't think that, well, because my account's small, I need to trade low price shares. It's much better to buy an expensive stock that's trending higher, but buy less shares of it because you're going to make more money. And especially these days with discount brokers, you should be trading with somebody like Interactive Brokers or TradeStation or E-Trade or any of these guys that charge very low commissions, so that the commission cost is almost negligible in your trade. It's a major fallacy in the world of swing trading and trading that trading a cheaper stock or even penny stocks. There's a lot of promoters out there saying, oh, penny stocks are the way to go because you don't need to make much, you don't need to have a big account to make a lot of money, and it's all, excuse my language, but it's bullshit. The reality is that really it's very difficult to make money in low price stocks. You know why? Expensive stocks are expensive for a reason. They're expensive because institutions, banks, mutual funds, hedge funds, and so forth are buying them. That's what makes them expensive. And they're buying them because they're good stocks. So don't focus on these low price stocks, those of you who are doing so. Okay, enough preaching. Go ahead, Rick.
With ROSG just going sideways here at the lows, really isn't something you want to get involved with until it can break above the 200-day MA. It's just been in a long-term downtrend, and it's pretty volatile as well. It's so volatile I can't really get a good chart on it. See how wide and loose the price action's been. In the short term, it's a good sign if it can get above the 4-day high. Might be able to head higher. Really shouldn't go back below 390. And probably won't go much of anywhere until it can clear the 200-day moving average. Next question is DSX. This is basically a trend reversal type of play. You have a longer term downtrend. You have tightening of the price action. Stock holds above the 50 and runs higher. I mean, it's basically a do nothing right now. And you have this, for example, when a stock sells off about 50%, it has to run up 100% to get back to the highs. Well, when a stock runs up 100%, it's usually got a base for quite some time. So off the lows, DSX is 53% off the lows. I mean, so it's going to probably need to relax some. If it keeps on going any higher, it's a 70% move just to get back to the prior high. So that's pretty tough. I think right now, you basically, if you're long, you just want to think about where you want to have a stop in place. Having one below the 20-day EMA minus some wiggle room is fine. And just let it continue to go up, but you're going to have to probably think about taking profits somewhere around the 930 to 960 area. If you're not already in, basically there's nothing to do right now. It's just too far extended. STJ on the weekly chart, I'll just go over some weeklies so I can see what's going on a little quicker. Really nothing going on. It's actually rallying into resistance up here. It's probably a place to get out if you're long, and move into something that's moving a little bit better. It really has a ton of overhead, as Darren's mentioned. Overhead resistance. It has these prior swing highs. It also has these lows that failed, that when the stock rallies, the support that was cracked then becomes resistance as well. And so it's got just a ton of overhead to fight through. Not an optimal place to be in right now. AVP, Avon Press. Let me see. There's a downtrend line. It's got to break for it to go much of anywhere. So if you're long now, I guess it's okay. I really don't know what to say. You really shouldn't see the stock dip back below 1350. No, in when we swing trade, we never want to see lower highs and lower lows, which is what's in place right now. So as long as this continues to set higher highs and higher lows, it's okay to hold. I'm sure if it can break this downtrend line, it'll probably trend back up to this 23 level. But there's no guarantee that it's going to do that. So, anyways, if you just want to keep an eye on it and make sure that the price action doesn't set new lows again. So 1360 area would be a stop. WLP long. On the weekly chart, looking like it's broken out from a basic consolidation here. Looking pretty good. Let me drop down to the daily real quick, and that's not an amazing base here. It's just kind of real choppy. It doesn't, when I see a really tight base, I see institutions participating in it, I get excited. This is a really choppy base here, but looks like it tightened up a bit over from the end of December on. So looks pretty good, but it's probably going to run into resistance with all this overhead above here. So you probably have until like the 60, maybe even this downtrend line here. So anywhere from 66 to 70, it could be in for some reversal action. So you're running into some overhead, as I said before. So tough to remain long. But if you're in from lower levels, you might, and you can sit it out. It might be able to hold up here, go sideways for a few months or weeks, and then break out from here and go higher. Just guessing there, I don't know, but seeing is that it is trying to set a bottom here and form several higher lows along the way. So it's going in the right direction. All right, CERN, great stock, breaking out, looks pretty good. As I'd say it's a hold as long as it can hold the put a stop below this last swing low, this dip, and the 50-day moving average. If it can't hold above that, it's turning into a dog. So looks pretty good here. Might need further consolidation, but this is basically a cup and handle type pattern. Nice basing action. Might not be a leader anymore, but it certainly is it's pretty strong stock. Netflix, big gap up from earnings. This is basically a sell if you had this prior to earnings. If you didn't have this, can't do anything with this right now. I don't. This is just a gamble to buy it here. Who knows what's going to happen? It's already extended from a base.
Yeah, with this type of play, I mean, what I like to see, if you get a big gap, I mean, you're probably talking a 1 to 2 week bull flag possibly, and then you wait for for the price action to move above the high of the downtrend line. But yeah, in the next, it's not really actionable in the next week or two, really, in my opinion.
Right. And in what Darren's speaking about, though, if a bull flag does form, these are for people who really know how to trade, because this is a higher risk pattern, and you're probably going to have higher volatility. And if you sit there and stare at it, and if it goes against you, you're going to be put in a world of pain. So you have to really operate quickly. So you're going to have strict stop loss discipline when you mess with something like that. But he is right, though. If it bull flags, it could potentially rip higher, but that's for a few weeks. Amazon in great shape, pushed higher today, as Darren talked about earlier. That shows relative strength. So if this is what you're in, good for you. You're in good shape. Stops below the 20-day moving average and this prior swing low. Yeah, so stop is about 4% away. So I think this thing looks pretty good. Just let it go. Look for about at the very least, I'd say about a 10% move from the breakout at 260. Anywhere from 10 to 15%. It kind of moves too slow to go for 20, but I think a 10% move would be a pretty good target. And Ma, same as V, a little bit of a pullback. Looks a little bit more bullish than V, only because it didn't have that monster, that ugly gap. I think if it can get back above this 3 or 4 day high, have a shot for it to go higher with the stop beneath the swing low and the 20-day moving average. I run some pretty obvious stops on these trades, and you know, if they get hit, they get hit. That's the way it goes. You don't really have to get so fancy with your stops. You should really pay more attention to your selection, getting the best stocks rather than focusing too much on your stop. What do you see in Pet M and Alum for an entry? All right. Well, with Pet M, pretty simple. Above 70. That would be the first entry. And if it rallies up here and stalls and goes sideways for a few days, you might get a shot at adding. So look for it to break above 70, stall around 71 for 2 or 3 days, and then break out again. That might be your shot to add. Let me see here. I don't BRK Berkshire, a pretty nice breakout. Something I never really look at this stock. So pretty strong. This is a nice cup and handle pattern with the gap up breakout. Extended, really nothing to do now except ride the wave up if you're long. And it's up 8%. So, you know, this is the kind of stock that's not your 20% mover. But so if it's up 8 to 12%, that might be a target area for you. But so far it looks pretty good.
All right. Rick, I think a good way to wrap this up would be, on your end anyway, would be with the next question, which is basically Raja is asking to advise on our basic criteria for entry and exit, I think in general, for trades, if you can kind of do a 1 or 2 minute summary. But if you could try to do that, and then I'll take over from there, and we'll wrap it up.
Well, actually, I could use the chart of Berkshire as an example, because really this is what we're looking for. Just usually we like to find stocks that have a little bit more, they're a little more volatile than Berkshire. You know, only has a $1 ATR on a $90 stock. Usually a stock of that price probably has at least a $2 to $4 ATR. So it is a pretty slow mover. But in terms of the chart, this is exactly what we look for. We look for a strong uptrend. All of our stocks must first pass through a trend filter, and the trend filter is simply the 50-day moving average is above the 200. The 200 is sloping higher, and the 20-day is usually above the 50 when we buy. When the stock is in base mode, the 20 will dip below the 50. That's normal, and that's fine. You want to see pullbacks anywhere from 10 to 20% off the highs. This is 8%, which is normal because it doesn't have a lot of volatility, as I mentioned before. In other stocks, such as, say, a Coors or DDD, or any of the stocks that are moving right now, you'll see a 15 to 25% pullback. That's fine. Anything more than 30, 35, if you're getting into 40 and 50, that's too much. So anyways, what we then look for after we have a little bit of a basing action is we look for higher lows within the base. We look for the stock price, the price action to get back above the 50-day moving average. And then we look for a breakout. Now, above a swing high. This entry I might have passed on only because it's the first higher low within the base. I prefer to see 2. But definitely this breakout here is something we'd have liked. The gap up would have been difficult to get a piece of that, but this reversal bar here is beautiful. And that's a great sign. So this is the breakout. It doesn't have to be in line with the left side high. Preferably, you know, I like to see a breakout below. I'll show you a good example of that. Here's the high in LL. The LL is something that we're in right now, and the breakout is about 3% below the left-hand the high of the left side of the pattern, which is what we're looking for. So again, I can go over LL. We saw two higher lows within the base and then a sideways price action, and then we want to buy the breakout. It's a very simple concept that takes a year or two to master, I think, or to train your eye to see. But it's a very simple concept. It's a tight base with the moving averages all lined up, and then higher lows on the right side of the pattern. And what I mean by the right side of the pattern is, here's the left side because you don't know if it's going to go lower or higher. Once it declares itself by breaking a downtrend line or getting back above the 20 and 50, it's now forming the right hand side. It's saying, hey, I'm strong. People are buying me. Makes our watch list, and then it stays above the 20 and then breaks out. Came back in today, but that was mostly due to the broad market. Still looking pretty good. So that's basically what we look for. In a nutshell, and then when the stock breaks out, we look for a pullback entry. These are the breakout and the pullback are about 95% of what we look for. So a breakout, then we look for a pullback, and that's it.
In an uptrend, of course.
Yes. As you see, LCC, same thing. You have the pullback, and then you have the 20 and the 50 and the 200 all sloping higher above each other. That's exactly what we look for. Momentum's on our side, and it makes it easier to swing trade. So that's it.
I am not one of these guys who likes to promote a lot of salesy stuff in webinars. In fact, I hate that when you try to go to a webinar and you think you're going to learn something and all they talk about is they try to sell you something. So I promise I won't do that. But just give me 5 minutes. I'm going to show you some things that might actually help you out. If you liked what we had to say tonight and you want to learn more about it, a lot of this can be done for free. So let me just show you a few things here on our website. This is our main website, morpheustrading.com. On our website, you can go to our blog. You click right here, our blog. And if you click on our blog, you'll go to this page. And on our blog, we post 3 or 4 times a week. Different technical analysis plays, just like we talked about tonight. Very educational, no hype, no nonsense, no BS. We just talk about patterns we like and stocks and why we think they'll go up. Now, if you're really serious about taking it to the next level, then what I would recommend is go to our blog and then click on this link right here, Swing Trading Course. It's under Learn to Trade Stocks. We actually have a course, a video course that you'll see right here. And this is actually a course that it's about a 7-hour course where we talk about all of our concepts, not only what types of trades we buy, but when to sell, when to exit, the psychology of trading, money management, all kinds of things. It's a great course, no matter whether you're a beginner or advanced. We have a full 45-minute video on here you can watch about our types of trades we buy. One last thing, we have a technical stock screener. The URL for this to go directly to it is screener.morpheustrading.com. This is a web-based stock screener. You don't have to download anything. It all runs on your browser, assuming you have an up-to-date browser. And this is designed to actually find the stock picks that meet our criteria. So there's a lot of stock screeners out there, but many of them you have to program or know what to do, or they're very complicated. Ours we designed to be very simple. We took our preset criteria that we use, and it's really as simple as 1 or 2 clicks. You select a country. We have 4 countries presently that we can select stocks from: India, U.S., Canada, and United Kingdom. Select stocks or ETFs. If you want to narrow it down to exchange, you can. And then you simply click, are you looking for breakouts or pullbacks, or if you want to sell short. Now, of course, selling short would only be in a downtrend. But for example, if we just click potential breakouts, and you can see it took, about 2 seconds, and it gave us a list of 20 results returned that you can see over here. Let me move that window out of the way. Okay, you can see 20 results returned. Over here, we can sort by relative strength. These are the strongest stocks over the past 6 to 12 months. If you click on any of these symbols, it brings up a chart. And it just shows you a very basic chart. Now, this is not designed to be a charting platform. The charting is pretty basic. It's designed to be a stock screening platform. But you can see here, it's a very quick way to save yourself hours of time. Instead of scanning through thousands of stocks, you can narrow it down to 10 or 20 stocks, or depending on market conditions, maybe more. You can click on any column heading to sort. If you want to sort by sector, for example, click on sector. You can sort by industry sector. You can sort by volume, by relative strength, any way you like. This is presently still in beta mode, so it's free. Anybody can access it. There's no registration required. In the next couple weeks, it's going to actually come out of beta mode and go into a live product with some additional services. It's going to be cheap though, less than $20 a month, and it's a great way to really narrow down. And if you really believe in this trading strategy that we use, it's a great way to, I guess I'd call it a first pass. This is a first pass, meaning that it's going to narrow it down to 20 to 50 stocks for you to look at. Now, if you really want to know the best plays and you don't want to mess around, or you don't have the time to actually look through all these stocks, then the best thing would be to subscribe to our actual newsletter on our homepage, morpheustrading.com. Just click on this button here, and then you can actually get a 30-day risk-free trial. You pay for it, but within 30 days, if you're not happy, we'll just give your money back. We're not bothered by that, no problem. We're pretty confident in what we're doing. And it's a good way to try out our service. And then what we do with that service is we actually give you specific entry and exit prices for the best plays. So the scanner is kind of a first pass, but the newsletter is shows you our absolute best picks with the exact entry and exit prices. So on that note, I'm going to wrap things up. Thank you very much, all of you, for attending this evening. I hope you enjoyed it. I hope you learned some things. We really enjoy sharing our knowledge, and we're looking forward to doing our next webinar.